Why did a $40 bill wreck Holden's entire afternoon when losing $400 the year before had barely registered? That question bothered him enough to start tracking it. Not what he spent the money on, but what it made him feel, the exact moment it left his hands or landed in his account. The $40 was a brake job. Nothing exotic, just the kind of repair every car eventually needs. The mechanic slid the invoice across the counter without much ceremony, and Holden looked at the number and suddenly felt 19 again, like the version of himself who used to choose between gas and groceries, a version he hadn't actually been in for more than a decade. He had $11,000 sitting in a savings account at the time. That's the part that should have made him laugh. It didn't. Driving home with new brakes and that old, familiar knot in his stomach, he finally admitted something he'd been avoiding for years. He didn't actually think of money as money. He thought of it as a verdict, a judgment on whether he was safe, whether he was responsible, whether some deep, unspoken part of him was still that broke 19-year-old, no matter what the account balance said. And once he saw that, he started noticing it everywhere. The ledger nobody asked him to keep. Here's the strange habit at the center of this story. Since college, Holden has kept a private ledger, separate from any bank statement, that nobody else has ever seen. It's not a budget. A budget tracks where money goes. Holden's ledger tracks something stranger. Next to certain amounts, in a second column, he writes down exactly what he felt the moment the money left his hands or landed in his account. Not categories, feelings, in his own words, no matter how small or embarrassing they seemed at the time. Flipping back through those old entries is a strange experience, even for him. $300, a security deposit at 23. Relief, like getting away with something. $12, a coffee bought on a stressful morning at 25. Guilt, disproportionate and completely out of nowhere. $9,000, a modest bonus at 28. Pride, but a jumpy, anxious kind of pride, like waiting for someone to take it back. $40, breaks, 31 years old. Fear, plain, old, and familiar. The dollar amounts, laid out next to each other, tell you almost nothing. The feelings column tells you everything, and none of it, if you're honest, has much to do with the actual math. That's when a pattern starts to emerge. Where the feelings came from. Holden didn't invent this pattern on his own. He grew up watching his father, a bookkeeper for a small manufacturing company, treat the mere idea of asking for more money as something close to bad manners. In 19 years at that company, his father never once asked for a raise, despite training 3 separate replacements for supervisors who were promoted past him. When Holden finally asked him directly why he never brought it up, his father said something that stuck with him for good. Asking to be paid more, when nobody had offered it first, felt grabby, the kind of thing decent people simply didn't do. He said it the way you'd state a rule of etiquette, not a financial strategy, and by his own logic, asking would have meant admitting he cared more about money than he was supposed to. Holden was 26 when he finally understood that his father hadn't been making a bad negotiating decision. He'd been making a perfectly consistent identity decision, using his refusal to ask for more as proof of his own decency. And that proof had quietly cost him a full decade of underpaid work. That's the pattern worth sitting with. Money stopped being a tool the moment it became a stand-in for something else entirely. In his father's case, it was being seen as a good, undemanding man, and the substitution didn't announce itself. It just sat there, disguised as humility, year after year, until the gap between what he earned and what he was worth became too large to ignore. The dangerous part is how reasonable it can feel while you're living inside it. The 4 hours he never billed. The first place this actually cost Holden something was his own tutoring program, a small after-school program he ran for extra income once demand at his school grew beyond what he could fit into a normal week. For 2 years, he kept his rate exactly where he'd set it at the beginning, even as 3 separate families told him directly they'd happily pay more, even as he added 4 extra unpaid hours some weeks just to squeeze in 1 more student he felt bad turning away. When the school offered him a modest stipend for running an additional summer session, he found himself trying to talk them down to a smaller amount, right there in the middle of the conversation, before the assistant principal offering it looked at him like he'd completely misunderstood the question. It took his sister, visiting for a weekend and watching him grade papers at 11 at night after a full day of tutoring, to say the thing directly. He was exhausted, resentful some weeks in ways he wouldn't admit out loud, and still charging a rate he'd have told any other teacher to double. Holden didn't have a good answer for her in the moment. Raising the rate, some quiet part of him believed, would have meant becoming the kind of person who cared about money more than the kids in front of him, as if the two things were actually in competition instead of completely unrelated. It took him another full year to raise the rate at all, and even then, he only moved halfway toward where it should have been. He wasn't being generous anymore. He was making himself cheaper so he could feel like a better person. The science of why money gets tangled up in a person. This isn't just a family quirk. There's real research describing exactly this pattern, and it has a name. Financial psychologist Brad Klontz, working with researchers at Kansas State University, studied what he calls money scripts, the largely unconscious beliefs about money that people absorb in childhood, usually before the age of 7, often without a single word of it being taught directly. His research groups these scripts into a few recurring types. Money avoidance, the belief that money is bad or that wanting more of it makes you a worse person. Money worship, the belief that more money will finally fix whatever feels unresolved inside you. Money status, the belief that your net worth is a direct measurement of your value as a person. And money vigilance, a more guarded, secrecy-driven relationship with money that can tip into hoarding when it goes far enough. Holden's father was a textbook money status case, wearing the costume of frugality. Holden, reading Klontz's research years later, recognized his own break job panic as the same script, just running a slightly different version. There's a second piece of research worth knowing because it helps explain why the feeling can hit so much harder than the number deserves. Behavioral economists Daniel Kahneman and Amos Tversky demonstrated, across decades of study, that losing a given amount of money produces roughly twice the emotional impact of gaining that same amount. Not a mild difference, roughly double. Which means a $40 loss doesn't just feel like $40, it can feel, psychologically, closer to losing $80. And if that $40 has also been quietly assigned the job of proving you're responsible, safe, or tough, the emotional bill gets bigger still, stacked on top of a psychological exchange rate that was never fair to begin with. The number stays the same. The meaning attached to it changes everything. None of this makes a person broken. It makes them human, running on wiring built for scarcity that most of us no longer actually live inside. The $12 he couldn't let go of. The second example is smaller and in some ways harder to admit because nothing about it was actually serious. At a group dinner with 5 old friends when he was 30, the bill got split evenly, the way it usually did, and Holden did the math afterward on his phone in the parking lot and realized he'd ordered $12 less than the group average. Nobody else at the table had done that math. Nobody else, as far as he could tell, had even looked at their phone. He didn't say anything that night. He also didn't let it go. Over the following weeks, $12 turned into a small, private ledger of its own, a mental tally of who ordered what at every subsequent dinner, who seemed to notice or not notice, and whether he was quietly being taken advantage of by people who called themselves his closest friends. He nearly skipped one friend's birthday dinner entirely, inventing a vague excuse purely to avoid another evening of doing math nobody had asked him to do. Eventually, one of those friends noticed Holden had gone quiet at group dinners and asked directly if something was wrong. Hearing himself say the words $12 out loud, looking at a friend's confused but genuinely kind face, was its own small, useful humiliation. The amount was never the point, and some part of him had known that the whole time. What those $12 had actually been tracking was something closer to a fear of being unseen or undervalued by people he loved, wearing the disguise of simple arithmetic. And arithmetic, once he looked at it honestly, had never been the thing keeping score. The decision to edit the ledger. Somewhere in his early 30s, Holden went back through years of his own feelings column and noticed something uncomfortable. Almost none of the entries described money as a tool. Nearly all of them described money as a mirror, reflecting back some judgment about his character, his safety, his worth, or his toughness. A hammer doesn't get to make you feel like a failure. A wrench doesn't audit your self-esteem. Somewhere along the way, without ever deciding to, he'd stopped treating money like either of those ordinary, useful objects and started treating it like a verdict that got reissued every time a number moved. So he did something deliberately strange. He started rewriting the entries, not the amounts, the feelings column, going forward one small habit at a time. The first change was almost embarrassingly simple. Instead of writing fear next to the $40 brake job, he wrote, "I spent $40 to make my car safer." It didn't magically fix anything, but it gave the money a job again. 5 entries he rewrote. The first rewrite was naming his accounts by function instead of leaving them vaguely labeled as savings. He split his money into buckets with plain, literal names. Roof, for anything related to housing and true emergencies. Repairs, for exactly the kind of $40 brake job that used to spiral. Actual fun, for spending with zero guilt attached, by design. A dollar sitting in an account labeled repairs stopped feeling like a referendum on his character the moment it had an actual, boring job to do. The second rewrite was a question he started asking before reacting to any financial decision that made his chest tighten. Would this bother me if it were a tool instead of money? If a wrench wore out and needed replacing, nobody would spiral about it. Applying that same flat mechanical question to a bill or a bank balance drained an enormous amount of unnecessary heat from ordinary decisions. The third rewrite was a simple waiting period. Any financial decision that arrived with a strong emotional charge, whether guilt, panic, or that specific manic pride he used to feel after a bonus, got a mandatory day or two before he acted on it. Not because delay always changes the decision, because it reliably separated the actual math from the emotional weather passing through him at that particular moment, and those two things had been silently merging his whole life. That small pause became one of the most useful habits he had ever built. The fourth rewrite was the hardest one to actually do, and the most useful once he did it. He built a small amount of truly guilt-free spending into every single month, a fixed sum he was not allowed to justify, track, or feel bad about afterward, on purpose. The goal wasn't the spending. The goal was practicing, on a small and repeated scale, what it actually feels like to use money the way you'd use any other tool, without turning every transaction into a character test. The fifth rewrite changed the language he used with himself during his own monthly check-ins. He used to ask himself, silently, whether he was winning or losing. He replaced that question with something closer to what an actual mechanic asks a gauge. Is this number where it needs to be for what it's supposed to do? Winning and losing are verdicts about a person. A gauge reading is just information about a system, and Holden, after enough repetition, discovered that his nervous system could actually tell the difference. The ledger now. He still keeps the ledger. That part never stopped. What's changed is what shows up in the feelings column. A recent entry, $60, a parking ticket he'd earned fair and square by running late to something. The feeling column, for the first time in years while describing an unplanned expense, simply says, annoying. Not a verdict, not a referendum. Annoying, the way a stripped screw or a flat tire is annoying. A small mechanical inconvenience that says nothing whatsoever about the kind of person he is. The brakes came up again recently too. A different repair, a different amount, on the same car. Holden paid it, mentioned it to his partner in passing over dinner, and didn't think about it again until he happened to flip back through the ledger weeks later and noticed there wasn't an entry for it at all. He'd stopped needing to log it. It had finally become exactly what it always should have been, a bill, not a verdict. And that was the real change. The expense hadn't changed. He had. A closing number worth knowing. There's a piece of research that lands differently once you've heard the rest of this story. In 2010, Nobel laureates Daniel Kahneman and Angus Deaton published a widely cited finding that emotional well-being rose with income only up to a point, somewhere around $75,000 a year, beyond which more money stopped moving the needle on day-to-day happiness. In 2021, researcher Matthew Killingsworth challenged that finding directly, showing that well-being continued climbing well past that threshold with no plateau in sight. Rather than argue past each other in competing papers, the two researchers did something rare in academic life. They joined forces, brought in a neutral third researcher, and reanalyzed both datasets together in what's called an adversarial collaboration. Their joint conclusion, published in 2023, split the difference in a way neither original study had predicted. For most people, happiness genuinely does keep rising with income, with no plateau, sometimes even accelerating among those who are already happy. But for one specific group, an unhappy minority within the data, happiness stopped improving past a certain income, no matter how much further the number climbed. Killingsworth put it plainly afterward: if you're financially comfortable and still miserable, more money isn't going to be the thing that fixes it. That's really the whole story, told a second time in a completely different language. For the people who've done the quiet work Holden did, separating the tool from the identity, more money keeps genuinely helping because there's nothing underneath it left to fix. For the people still running an old script, using every dollar as a stand-in for safety, worth, or toughness, no amount of additional money will ever be enough to settle an argument the money was never actually equipped to have. Holden's ledger, these days, mostly just sits there, quiet and a little boring, tracking numbers that no longer have much to say about who he is. He considers that boredom, honestly, the best return his money has ever produced. POV. You protect what your business finally started making. You've spent years picturing the day it finally works, the day the business clears real money, the day the number in the account stops looking like a typo. Nobody spends much time picturing the 18 months right after that day. Foster didn't either, until he was living through them. He'd built a commercial cleaning company from a single office contract at 26 into something that, by 34, cleared just over $600,000 a year in profit, with crews covering 11 buildings across the city and a payroll of 41 people who depended on him getting the business decisions right. The morning his accountant called to confirm the previous year's number, Foster sat in his truck in a parking garage for a long moment before starting the engine, feeling something that wasn't quite joy. It was closer to vertigo. He had built something real, and building it had taught him almost nothing about how to hold on to it, because holding on to money, it turns out, is a completely different skill from making it. And that gap is what this story is actually about. The Money Vault. The first thing Foster got right, mostly by accident, was refusing to let all his wealth live inside the one thing that had created it. For the first 2 years after the business became genuinely profitable, nearly everything he owned was still the business itself: its contracts, its equipment, its receivables. A single lost contract, a single lawsuit, or a single bad year could have erased most of what he'd built in an afternoon. He didn't fully understand how exposed that made him until a competitor, 2 towns over, a facilities company run by a man named Dale Hutchins, whom Foster had met a few times at industry meetups, lost its 2 largest accounts within the same quarter. Both clients were consolidating vendors after a corporate merger that neither Dale nor Foster had seen coming. Dale's company had looked, from the outside, exactly as sturdy as Foster's own. Similar revenue, similar headcount, similarly proud of what he'd built. Within a year, it had folded entirely, not because Dale had run it badly, but because every dollar he owned had been sitting inside the one structure that could disappear in a single bad quarter. And then it did. So Foster started routing a fixed percentage of profit every quarter into things that had nothing to do with cleaning contracts. A modest, unglamorous mix of index funds, a small stake in 2 rental properties bought slowly and conservatively rather than leveraged aggressively. None of it was exciting. That was the point. The business was already his big, concentrated bet. The rest of his money didn't need to be. The other half of the money vault, the part almost nobody talks about, was finding a tax advisor and actually staying with her. Foster had used 3 different accountants in his first 5 years, chasing whoever was cheapest that season, until a fellow business owner told him plainly that he was managing his tax exposure like a stranger managing his own health records, starting over with a new professional every year or two, with none of them ever having the full picture. He hired Priya Osei, a CPA who specialized in service-based businesses, at 30 and simply never left. 6 years in, she knew his business better than most of his own employees did. Which contracts carried the thinnest margins, which quarters historically ran tight, and when a piece of equipment was worth buying outright versus leasing for the depreciation. In year 2, she called him on a Thursday afternoon, not for their scheduled quarterly meeting, but because something in his filing structure had been bothering her since the previous week. She'd noticed he was classifying a piece of equipment financing in a way that technically worked, but left roughly $11,000 in avoidable taxes sitting on the table, a structuring mistake buried 3 layers deep in paperwork that any accountant meeting him for the first time would have had no reason to question. She caught it not because she was smarter than his previous accountants, but because she'd been watching the business long enough to notice something that looked wrong against everything she already knew about it. That kind of catch doesn't happen in a single annual meeting. It happens because somebody sticks around long enough to actually know you, the same way a family doctor can catch something a walk-in clinic never would, simply by having years of your own baseline to compare against. The health vault. The second vault cost Foster more than he likes admitting. In the 5 years before the business became truly profitable, he skipped almost every doctor's appointment that wasn't an emergency, ate standing up between job sites, and treated a persistent lower backache as an inconvenience instead of a warning. Researchers studying entrepreneurial mental health, including a widely cited 2019 study out of UC Berkeley, have found that business owners report meaningfully higher rates of depression, anxiety, and substance-related issues than the general working population. The pattern, researchers found, had less to do with the stress of any single bad day and more to do with the accumulated effect of treating your own body as the last item on a list that never actually ends. Once the money started arriving reliably, Foster made a rule that felt almost silly to write down: an annual physical, no exceptions, scheduled a year in advance so he couldn't quietly let it slide. The second time he did it, at 35, his doctor sat him down after the blood work came back and didn't open with reassurance. She opened with a number, his cholesterol, which had been trending upward for at least 3 consecutive years based on the one prior data point they had. Then she told him plainly that this was exactly the kind of thing that gets caught early, but only when someone bothers to keep checking on purpose. Nothing dramatic happened after that appointment. He adjusted his diet, started walking most mornings before the crews arrived at the first job site, and watched the number come back down within a year. Nothing dramatic happened. That was the entire point of the vault. Health, unlike a contract or an investment, doesn't send a formal notice before it collapses. It just quietly erodes until that erosion becomes the emergency, and by then, the options are worse and more expensive in every sense of the word. The goal isn't to wait for something to go wrong. It's to notice when something starts changing. The family time vault. The third vault took Foster the longest to actually believe mattered, because money seemed, on the surface, like it should have solved the problem automatically. It didn't. He missed his daughter's first piano recital at 31 because a client's building had a plumbing emergency at exactly the wrong hour, arriving at the school just as parents were filing out of the auditorium. His daughter already back in her regular clothes, her program still folded in her hand. Standing in that emptying hallway, he told himself this was a temporary season, the price of building something that would eventually buy back all the time he was spending now. He repeated some version of that sentence to himself for the better part of 2 years. The uncomfortable truth he eventually had to face was that more money doesn't automatically return the time it once cost. It only does that if you deliberately convert it into fewer hours worked, rather than a larger house or a nicer truck. So at 33, once the business could genuinely run without him present every single day, Foster built a hard rule into his calendar. 2 full weekday afternoons permanently blocked for his kids, treated with the same seriousness as a signed contract, and immovable for anything short of a genuine emergency. His operations manager, not Foster, now fields the plumbing calls that used to end recitals early. It wasn't just a calendar change. It was a decision about what the calendar was supposed to protect. The business didn't suffer. At his daughter's second recital, 2 years later, he watched from the second row, close enough to see her scan the audience before she sat down at the piano, find him, and only then seem to relax into the bench. He hadn't told her he'd be early. He'd simply been there, which turned out to be the entire message. The meaning vault. The fourth vault is the one Foster is worst at explaining out loud, even though he's sure it matters as much as the other 3. At 36, with the business stable and the money vault genuinely working, he took his family on a 5-week trip through Vietnam and Portugal. It wasn't a resort trip. He deliberately structured it around living for stretches inside neighborhoods rather than hotels, eating what people actually ate rather than what tourists were sold. One afternoon in a small town outside Hoi An, he sat with a family that ran a noodle stall from the ground floor of their own house. 3 generations working the same 12 feet of sidewalk. Through their daughter, who translated for them, he asked whether they'd ever thought about expanding, opening a second location the way he once had. The grandmother laughed, not unkindly, and said something that took a moment to translate properly. A second location would mean less time watching her grandchildren grow up in the kitchen behind her, and no amount of extra money was worth that particular trade. Foster had spent a decade treating growth as an obviously correct instinct, never once questioning whether it was actually the goal or simply the assumption underneath the goal. That question stayed with him long after they left. There's research explaining why this specific kind of experience matters in a way a beach vacation doesn't quite replicate. Psychologists Shigehiro Oishi and Aaron Westgate, in work published in Psychological Review, argue that a good life isn't just the happy life or the meaningful life that most self-help advice focuses on. There's a third, separate dimension they call the psychologically rich life, built around novelty, perspective shifts, and genuine unfamiliarity. Their research suggests it predicts life satisfaction in ways that are distinct from happiness or meaning alone. Foster came back from that trip without a single new business idea, which surprised him a little. What he came back with instead was a recalibrated sense of scale, watching a family build something genuinely rich on a fraction of what his own household spent in a month, in a country whose recent history had been shaped by hardships he'd only ever read about in passing. Wealth, seen from that distance, stopped feeling like the entire point of the exercise and started feeling like one tool among several. Why he never fully stopped. This is the part of the story that surprises people who assume the whole goal was to eventually stop working completely. Foster didn't. At 38, with more than enough money to walk away entirely, he still oversees the business 2 or 3 days a week, deliberately and by choice rather than necessity. There's a specific piece of research behind that decision too. Economists Suzanne Rowetter and Robert Willis, in a paper published in the Journal of Economic Perspectives, studied cognitive functioning across countries with different retirement ages and found a consistent pattern they called mental retirement. People who stop working earlier tend to show measurably faster cognitive decline than people doing comparable work who keep working longer, even after accounting for age and health. The mechanism isn't mysterious. Sustained mental engagement, the kind an actual job forces on you, whether you feel like it or not, appears to function like exercise for a part of the mind that otherwise quietly goes soft. Foster had watched something similar happen to his own father, a plant supervisor who fully retired at 62. The first year looked like exactly what everyone promises retirement will be: mornings with no alarm, a garden that finally got real attention, and a genuine, visible relief settling into the man's shoulders. By year 3, the visits felt different. His father repeated stories within the same conversation without noticing. He'd stopped tracking small logistics he used to handle without effort, like which grandchild had which allergy and which bill came due on which day. Those details had nothing to do with memory loss in any clinical sense his doctor could point to, and everything to do, Foster came to believe, with a mind that had simply stopped being asked to do anything difficult on a daily basis. Nobody in the family used the word decline out loud. Foster used it privately, to himself, more than once. So Foster built a different shape of work instead of walking away from work entirely. Fewer hours, higher leverage decisions only. An operations manager handling everything that used to consume his days. The business still needs him, but in a much smaller and more deliberate dose. And he's come to believe that dose is doing something for him that no vacation or investment return ever could. The silence fault. The 5th fault is the one Foster almost got wrong, and the mistake, when it happened, taught him more than any of the others. At a family gathering not long after the business crossed its first truly large year, an uncle asked him directly, in front of a room full of relatives, exactly how much he'd made that year. Foster answered honestly, a little proud of the number, watching a few eyebrows rise around the table. He didn't think much of it in the moment. He remembers actually enjoying the silence that followed, mistaking it for admiration. It wasn't. Weeks later, a cousin who'd always been close to him started declining invitations, brief and vague each time. An aunt made a pointed comment at the next gathering about people who forget where they came from, said lightly enough to be deniable, but aimed clearly enough that everyone at the table understood who it was for. Nobody confronted him directly. The room had simply, quietly, recalibrated how it saw him, and there was no version of an apology or clarification that was going to undo a number that specific once it was out in the open. Economist Richard Easterlin's decades of research on income and satisfaction help explain part of why that happened. People's sense of how well they're doing financially is shaped less by their absolute number and more by comparison with the people around them. Once you hand someone else your specific figure, you've handed them an instrument for measuring themselves against you, whether either of you wanted that or not. Foster hadn't meant to insult anyone. He also hadn't meant to hand out a scorecard. Both things happened anyway. He doesn't share the number now, with almost anyone. Not out of secrecy for its own sake, and not out of shame either. His wife knows the full picture, because a marriage without full financial visibility between partners is its own kind of risk, a different vault entirely, one built on trust rather than concealment. Beyond her, the number stays his. He's also become careful, in a way he wasn't at 31, never to let a nicer truck or a bigger house do the talking he used to do carelessly with his own mouth. Flexing, he's noticed, rarely earns admiration from anyone whose opinion actually matters, and reliably earns resentment from several people whose opinion he'd rather have kept. What security actually turned out to be? Put the 5 vaults next to each other, and the actual definition of financial security stops looking like a single number. It starts looking more like redundancy, money that isn't only in the business, a body that's actually been checked rather than assumed fine, time with the people who matter that isn't waiting for some future version of himself to get around to it, a mind that stays engaged instead of retiring wholesale, and a reputation that isn't quietly taxed every time he opens his mouth about a number nobody asked him to share. That was the part Foster hadn't understood when he first started chasing the money. None of the 5 vaults, on their own, would have been enough. A big number in a brokerage account doesn't fix a marriage strained by 10 years of missed recitals. A rich family life doesn't protect the business from a single bad lawsuit if everything is still concentrated in one place. Foster didn't build these in the order this story tells them. He built them the way most people actually build anything worth keeping. Badly at first, out of order, mostly by getting one of them wrong before he understood why it mattered. He's 39 now. The business still runs, smaller in his daily life than it used to be, and larger in the world than it's ever been. If you're standing where he stood at 34, staring at a number that finally looks real, here's the honest version of what comes next. The money was never actually the hard part. Building enough vaults to protect the life the money was supposed to be for, that's the actual job. And it starts the same day the first one does.